Hi, my name's Alison Trant, and I'm a director in the debt advisory team of PKF Francis Clark. It's my second time presenting at the Finance Director Seminars, so I might have seen some of you before. But just to recap, along with my colleague Jeremy Richards, we joined the firm a year ago from a banking background, having spent 20 years in various high street banks, and then more recently 5 years in the alternative funding market. We form part of the corporate finance team, so we're here to support our corporate finance colleagues on any transactions that have a debt requirement. But in addition, we provide a service to all the clients of the firm with any of their banking and funding queries. So I thought I'd start with the all-important current outlook on interest rates. So we currently have Bank of England base rate at 5.25%, which was 14 consecutive rises. But what's the graph? The graph is telling us that the current forecast is that we expect this to be about the peak, and with some reductions hopefully occurring throughout more likely towards the end of 2024. And then the more medium-term outlook is getting nearer to 4% by 2028. The last time that I showed you this slide in the beginning of the year, the outlook was to get as low as 3%. So there has been a shift upwards, but a reduction in the near and medium term nonetheless. So I wanted to share with you some data on the current lending markets. This data is compiled by UK Finance, which delves into whether the funding needs or how the funding needs of SMEs are being served by both high street banks and the alternative funding market. So this first graph is specifically gross lending by the high street banks. We've got three bar charts there, the light green being 2021, the navy blue 2022, and 2023 in the red so far. So you can just see, sort of visually looking at it, that lending levels are reduced from pre-pandemic levels, quite considerably so. The high interest rates, which we've just talked about, is part of the reason for that, but also coupled with a general cautiousness on the outlook for the future is both resulting in borrowers not having a strong appetite to borrow if they can avoid it, and equally the lenders not being able to deploy as much due to debt servicing interest rate calculations. Second piece of data focuses on specifically the product set of invoice finance and asset-based lending in the lending market. Asset-based lending being lending against the assets of debtors, stock, plant and machinery, and property. And what we are seeing here, this data shows the role of the proportion that product set within the lending market plays, and between 2020 and 2022 it has doubled, so it's quite a significant increase, and our view is we expect this to continue to rise, that more lending will be deployed under this product set. What's the reason for that? It affords the lenders more comfort because there's asset backing behind the facility. And they can price more competitively for that reason as well. But moreover, we have seen a rapid increase in the sophistication of this product set. Lenders now have access to good technology through open banking and various other means where they can speak directly to your systems and your management information and extract that data. Until sort of 5-10 years ago, it was a manual upload and therefore quite a time-consuming exercise for finance teams, which could be a hindrance to deploying this. Those barriers are being removed, and we are seeing, the continued rise. There's also more and more entrants coming into this marketplace in this product set. So as we see, if you haven't yourself explored your asset-based lending options, I think it's a worthwhile exercise doing so to realise what extra firepower could be available in your business. My third data set focuses specifically on overdraft utilisation by SMEs and also the other side of the balance sheet, the level of cash deposits being held. The snapshot is showing us that there has been, this is from 2020 to current times, there has been healthy levels of financial headroom held by SMEs. We have seen on the overdraft utilisation some slightly more usage. Pre-pandemic, average utilisation of overdrafts was 56%. It is currently tracking at 49%. So whilst, and it was 46% last year, so we are seeing slightly more usage of overdrafts, albeit still quite significantly below what it was the norm before the pandemic. On the other side of the balance sheet, then, this is mirrored in terms of we are seeing healthy levels of cash deposits being maintained. And again, we are seeing some dip into them, but not significant. And it's worth noting on the subject of cash deposits, whilst interest rates are high if you're borrowing, on the other side, the lenders are offering some attractive rates if you're maintaining cash balances. For example, there's currently an instant access business deposit that's paying 4.5%. If you are able to earmark some of your funds for a longer term, you can currently obtain over 5%. So again, worth looking into if you've not done so already. Whilst healthy levels of financial headroom are being maintained generally across the market, which is great to hear, we are obviously in a high interest rate environment seeing times of stress. We have had the specific request from our audit partners and our restructuring and recoveries colleagues to focus some attention on the specific subject of covenants, because in the current environment we are seeing an increased number of breaches, or where clients are taking out new borrowing, perhaps covenants featuring more than you as a client might be used to previously. So we'll spend some time just going through what we specifically see on covenants. First and foremost is what is the purpose of the covenant? And it's quite simply conditions, a set of terms that are input into a lending agreement to monitor the performance of your business. They should act essentially as a warning signal for the lender to avoid the event of default, with that event of default being failure to make repayments. So there's different types, so that you'll get your standard terms and conditions within your loan agreement. Covenants should be specific to your facility and indeed your business and business performance. Different types of covenants. They fall into sort of three general categories. The first of those being what we refer to as a viability covenant, essentially monitoring the performance of the business, as I say, to avoid or give early warning signals that could potentially result in a default position. The most typical ones we see in this space that you might have heard of or indeed have currently is interest cover and debt service cover, which will take into account your capital repayments as well. Second category is what we refer to as security covenants, and they are essentially monitoring if there's assets backing the borrowing by way of security, that those assets are maintaining an agreed de minimis levels. By far the most common is loan to value covenant. If there's property assets in the equation, you might also see something like debtors cover, for example. And lastly, the category of covenants can fall into is information-based covenants. So an agreed production of information at agreed intervals between the client and the lender. I haven't seen one that doesn't involve the requirement to produce at least a full set of annual accounts or audited if you fall into that threshold. But also, and more often than not, we also see the inclusion for the requirement of management accounts at either monthly or quarterly intervals. They could also include the request for debtors and creditors listings, or if you're a property-based business, a property investment-based business, for updated rental schedules. So lots of different types. You might just have one or two, you might have a full suite. It will depend on the complexity of the borrowing. Our advice to you is always prevention is better than cure. Enter into covenants and develop a full understanding of why the lender is introducing them, and their definitions, importantly. The definitions can vary, and what they're including in those. So get a full understanding and ask your lender to explain that thoroughly. You should also understand the timing of your covenants. They can be tested at certain intervals, and this can sometimes see that result in a breach unnecessarily so. If there's particular peaks and troughs in your trading cycle, the covenant test could fall at one of the troughs, resulting in a breach which isn't actually a true reflection of what's going on in the business. And you might need to alter the covenant to actually that it's on a rolling 12-month data basis, for example. And lastly, there should be a good degree of headroom in your covenants. You shouldn't draw down your loan agreement and then be immediately bumping against them. So it's important to do your forecasts and run your covenant tests, and as I say, enter into the negotiation with the lender at the outset. And just to remember that they should serve as a monitor and not be a hindrance to the running of your business. That all being said, forecasts, even with the best of our ability, we don't know what will happen, and things do happen that we weren't expecting, and thus breaches do occur. So what happens in the event of a breach? We strongly recommend that you immediately engage with your lender. We do see a lot of tendency to try and avoid the situation if you know that you think it's just a temporary blip and you'll be back on track. But regardless of what the situation is, you should enter into a dialogue with your lender as to what the reasons for the breach are. And then indeed, if it's temporary and something can be done about it, go into that conversation with a really, really good set of up-to-date information and forecasts. That's exactly what the lender will be looking for and will require in order to work with you through the breach. As I say, it entirely depends on the circumstances that's caused the breach. If it's temporary, fine, we can agree that it's going to be reset at the next interval and we can move on. Or indeed, it's something slightly more substantial might be required. For example, the lender could perhaps enter into an interest-only period to allow some more headroom, or indeed completely restructure the borrowing over a longer term. Or if you believe there has been a major sort of downturn, and then perhaps even more substantial repairs are required, such as pledging more security if it's an asset-backed lending situation, or indeed injecting more capital into the business. But be prepared for what you believe will be the remedies to the situation and have the financial information to back that up. Worth noting as well that when a breach occurs and you're forecasting to correct and remedy the situation, get into a negotiation with the lender as to what the outlook will be when that happens. For example, if the lender evokes an increase in your interest rates at the time of a breach, which they may well be entitled to do so, because they deem the risk profile to have altered, well, agree to negotiate that if the situation is remedied and improved, that you can return to reduced pricing, for example. But always is here, if you're in any difficulty with these conversations or unsure, please do seek some external advice. We are here to help. So that was a snapshot summary. We started off by having a look at the interest rate outlook, which is, we believe, in summary, that it's at its peak and the outlook is more favourable. We looked at the gross lending levels, and whilst lending levels are lower just due to appetite and conservatism, the lenders are open, the high street banks are open and deploying capital, albeit they remain conservative. The alternative funding market and indeed equity markets are awash with liquidity. So we would encourage you to explore those options if you haven't done so already. If you're in the fortunate position to be maintaining healthy cash balances, do explore the deposit rates. There's some attractive ones even on instant access at the moment. And we spent some time focusing on covenants, enter into them with a full understanding of what they entail. And in the event that a breach does occur, again, engage immediately with the lender with up-to-date information. So I hope that helps provide an update on the current banking and funding markets, and just to reiterate that we are here to support any queries that you may have. Thank you.